In this month's economic update, Kaplan Professionals' Michael Pollock speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professionals' monthly economic update. I'm Michael Pollock, and this month we're speaking with Chief Economist at AB, Guy Bruten. Thanks very much for joining us today, Guy.
My pleasure.
Firstly, let's take a look at the US. Consumer confidence is currently at its highest point since 2000. To what extent could that be eroded if the Trump administration's promised tax cuts are pushed to the end of the year and even later for fiscal stimulus programs?
Look, I think one of the things that's important to recognise here is that it's not just consumer confidence that it's at a high. There's a whole range of indicators when we look across business surveys, surveys of housing and so on. They've all been very robust. And you can pinpoint the turn in many of those indicators back to Q3 of last year. So well before we had Mr. Trump become President of the United States. And it's not only in the US that we've seen a turn in these things, it's quite across the board globally. In Europe, in Japan, in the rest of Asia, you can find a wealth of indicators that show that the global economy was on a better footing as we went into the end of 2016. Now, there's no doubt that the enthusiasm around Mr. Trump's fiscal plans probably contributed to that to some extent. But if we get disappointment on that front, I don't think we reverse all of that optimism about the cyclical recovery. So it's one of the things we're watching, but it's not enough, I think, to fundamentally change the picture of still a fairly decent global cyclical recovery. The other thing there is to be mindful of what markets are already pricing. If you look at what the bond market is pricing, for example, they're looking for a modest continuation of tightening by the Federal Reserve, certainly not factoring in the full extent of Mr. Trump's fiscal plans.
How would you respond to the idea that low growth in the US and other developed economies is a long-term trend or even the new normal?
Look, we have a decent amount of sympathy for that view. And there are a whole host of things which contribute to that. The ageing demographic profile of many of the advanced economies, question marks over the true pace of productivity growth, and importantly, the levels of debt in the global economy. So even though there has been some efforts to deleverage, particularly at the private sector level, when you look at overall leverage in the global economy, it's actually higher today than it was going into the global financial crisis. So we've seen almost no deleveraging at all. And as a consequence of that, that is still a constraint upon the pace of growth and a constraint on how policymakers are able to conduct the implementation of growth advancing policies.
So with the Fed having hiked rates in March, how many further increases do you expect this year?
Look, I think it's important to understand the regime that's allowed the Fed to tighten, both late last year and early this year. So the mindset that the Fed has is the economy's recovering strongly enough to allow some normalisation of interest rates. Inflation is sitting around about 2, but it's not accelerating rapidly. And if that's the regime we're in, then I think for the rest of this year we could see another 2 rate hikes. The more interesting thing, I think, as we get towards the end of this year is not so much the rate hikes, but what will the Fed do to its balance sheet? So there's increasing chatter around unwinding the holdings of both Treasury and mortgage-backed securities that the Fed has on its balance sheet. How markets respond to that in 2018 will be an interesting question. And the second element, I think, here is what happens to Chair Yellen, because her term expires early in 2018, and who's going to be Yellen's successor will be an important question next year in terms of determining the path that the Fed goes down. But for now, I think it's status quo, a couple of rate hikes before the end of the year.
Turning to China, how sustainable is the government's policy of relying on the expansion of credit in the financial system to reach economic growth targets?
Look, I think the Chinese authorities have already given us an answer to that. They've made it pretty clear that they don't want to accommodate a substantial further increase in the amount of debt in the economy. When I spoke earlier about the growing levels of debt in the global economy post-GFC, China is one of the areas where that is very clear. So the lack of desire to see debt growing anymore is already putting some constraint over what policymakers are willing to do.
Would you say that the consistency of Chinese economic data, such as the growth rate for 3 consecutive quarters last year, is a function of the centrally controlled economy or inaccuracies in the calculations?
These question marks about China's GDP numbers come up all the time. And I think certainly on a quarter-to-quarter basis, we'd be very loath to take the numbers literally. But if you look at them on a trend basis, they're telling a roughly right story. So for example, in 2011, real GDP growth was at 9.5. It's come down to 6.5-ish now. Nominal GDP growth, so the impact of prices as well, was 18.5% in 2011. It's come down to around about 8. So the GDP numbers are telling you broadly what's happening to the Chinese economy, that there's been a substantial slowing in the pace of growth in both real and nominal terms. There's also partly a signalling thing here as well, that if you think of how the Chinese authorities framed the outlook, as they've done this year, to say that growth is going to be 6.5 or perhaps a little better, there's a clear signal of policy intent relative to what they have been printing the GDP numbers at. But in terms of getting a better gauge for what's actually going on month to month in the Chinese economy, there are a whole raft of other indicators we prefer to focus on, as well as calibrating those statistics with our kind of on-the-ground efforts. So my colleague in Hong Kong was in Beijing last week, for example, meeting with a whole range of officials and other parties to try to gauge where the true picture is between the data and the anecdotes that we're picking up.
Looking at Europe, the market response from the signing of Article 50 was relatively subdued. But how do you see things playing out as the UK negotiates its future relationship with the EU?
Look, I don't think we were terribly surprised that the market reaction was pretty muted to the triggering of Article 50. Everyone knew that was going to happen, and if anything, the tone around that was a little bit more conciliatory than, say, a couple of months ago. We suspect there's not going to be a lot happening in the very near term. A lot of the discussions initially are going to be around the bill that the UK is going to have to pay to meet its EU obligations. So there's going to be some debate about that before we even get on to the more interesting stuff, which is the nature of the trading and financial relationship between the UK and the EU. It seems to us that we're unlikely to see any meaningful negotiations happening until we get beyond the German elections in September. Once we get over that hurdle, then there's going to be the prospect for more spirited negotiations. And so I think we'll see a reasonable amount of spirit in those spirited negotiations. Ultimately, we think that there will be an agreement reached which tries to limit the damage to both sides. But I think there's going to be a lot of noise before we get to that point. In the meantime, for the UK, then that means focusing on how the economy plays out over this year. And one of the themes that's happening there is that we still see very subdued wages growth. That's something we see across the globe still. But in the UK, inflation's rising quite rapidly. And that rise in inflation is squeezing real wages. And so we're likely to see much softer consumption growth this year. And so we think the idea that the Bank of England is going to respond to that higher inflation by hiking rates is probably misplaced.
And finally, the domestic situation. Where do you stand on the argument that the economic stimulus from the recent company tax cuts will not be sufficient to cover the drop in tax revenue?
Look, I think the modelling on this that's come from Treasury and others suggests that the impact of the cut in corporate tax rates is drawn out over time in terms of its impact on growth and is ultimately fairly modest. And that's not too surprising because The main impact when we're talking about the impact of a company tax rate cut, given our system of dividend imputation here, is on the decisions of foreigners to allocate more or less capital to Australia. And so I think there's actually a slow impact on the economy. And the horizon that we're more or less interested in, the next 1 or 2 years, I don't think it's going to have a major impact on macroeconomic thinking.
Apart from increasing supply, what policy measures do you think would help alleviate the problem of housing affordability in Australia?
So I do think the supply stuff is important, but we're already seeing substantial changes on that front. We've already seen quite a boom in residential construction activity. Over the next 12 months, we'll see the peak of that, but that's adding substantially to physical supply. And particularly in the apartment sector, where we're seeing indications, if anything, that oversupply is starting to emerge. But there are a number of other policy initiatives that could be taken. I think Governor Philip Lowe's point about effective supply is a good one, that building out infrastructure helps this housing stock that we have be more effective as supply. So that's one of the key policy measures that could be implemented, although that's a longer term thing. But there are other policy measures which affect the demand for housing as an asset class. So the initiatives to reduce the attractiveness, so around changing capital gains tax, which seems to be on the agenda for the May budget, around negative gearing, perhaps not so much on the agenda, but also changing the attractiveness of Australian housing as an asset for overseas investors as an important set of policy initiatives. So the differential tax regimes, for example, we've seen put in place in places like Victoria are not in that direction. I think there's also a role here for thinking about demand, that we are continuing to run a substantial immigration program, so there are question marks about whether that is feasible against the backdrop of limited investment in infrastructure. And finally, the measures that we're seeing on the macroprudential front, so to the extent the credit provision is an issue here, the tightening of regulations, tightening of macroprudential requirements that we've seen by APRA, even in the last week, are not in that direction as well. So I think the interesting thing here is that we are now seeing a number of policy initiatives across a whole raft of areas which do have the potential now to impact the house price outlook.
So what's your overall outlook for the Australian economy for the remainder of 2017?
For quite a while now, the Aussie debate, I think, has been couched in terms of this tug of war between the mining sector on the one hand and housing on the other. So from 2011 onwards, as mining became a much bigger drag on the economy, falling prices, the collapse in capital spending, housing was the key factor working to buoy the overall economy against that drag. And that was relatively successful. Unemployment hasn't risen anything like you might have feared given the size of collapse in mining. Now we're coming to the end of that drag from mining. It's very clear that prices have started to turn. We're almost at the end of the big downturn in capital spending. We're nowhere near, as an aside, seeing capital spending start to lift again, but we're at the end of the big drag. So the question now becomes, how quickly does the housing sector turn? How quickly does it go from being a big positive for the economy to a big negative? And I think we're seeing the warning signs on that front already ramp up quite aggressively. So I think that by the time we get through to the end of this year, there will be clearer signs that the adjustment in housing is becoming more disorderly, that construction activity is starting to peak, and that house prices are under some more downward pressure. So that leaves me overall probably a little bit more gloomy than the consensus about the outlook for Australia. I think that by the end of the year we'll be in an environment where unemployment is rising, where rate cuts are perhaps back on the table, and the Australian dollar's under a little more downward pressure.
Thanks very much for your time today, Guy.
My pleasure. Thank you.